Good afternoon, everyone, and welcome to the event, Why Are Pensions Important? My name is George Stoy. I'm an Associate Director at the IFS, and I'm going to be chairing today's session. This is the first in a series of public economics lectures, which look at a range of topics in public economics. And they're going to be on every Monday at the same slot, so if you're interested, please join us. Next week, we'll be talking about income inequality. So what's going to happen today is that my colleague, Heidi Karolainen, is going to talk to you about pensions, why we as economists think that it's important that people save, and how you can motivate them to save more. She's going to talk for about 40 minutes, and then there's going to be time for a question and answer session. And those questions are going to be based on questions from the audience. So if you could get typing away on Slido as the talk goes on, we'll return to those questions and see what Heidi has to say about them at the end of the event. So without further ado, I'm going to pass on to Heidi.
Thank you very much, George. So yes, as George mentioned, I'm Heidi Karolainen. I'm a research economist at the IFS, and I'm going to be talking about why are pensions important? And to answer this question, I'll start by talking about why people save for retirement and why they should save for retirement. I'll also talk about what is it about pension saving in particular that means that governments tend to intervene in pension saving. And then I'll finish off with talking about the UK pension system in particular. So how does the UK government intervene in people's pension saving, and how and why has that changed over time? So to start off, I'm going to just generally talk about pension savings. So as I mentioned, why do people save for retirement? Why should they? And I'm going to start by talking about a standard life cycle model. So this is a model of saving and consumption that we use in economics, where we have periods where people work and they receive income. And in each period, people can choose to either save or they can choose to consume. So if they basically face this trade-off. If they consume today, they get the benefit of that today. But if they save, they can consume later. And the most that people can consume or save is the total of the income in that period and any kind of accumulated savings from previous period. And I'm going to start by introducing the most standard version of this model, where we assume perfect certainty, so people can make these decisions with perfect knowledge of the number of periods that they will live and work and so on. And they also know what their income is going to be in each of those periods. And I'm going to discuss why that might not be a reasonable assumption in a bit, but we'll start with the very standard version of this model. We could also add things like returns on savings or borrowing against future earnings and things like that in this model, but we're not going to be showing that here. So here we're going to be looking at an individual, and this individual is working from age 22, and they're going to be working until age 68. And they're earning £25,000 a year. And they know that they're going to live until the age 100. So they know that they will have this 32 years period of no income. Now, why might people want to save for retirement according to this very simple model? Well, they might want to smooth consumption. So in order to maintain a level of income and consumption in retirement, people will have to save during the years when they work. So for example, if we assume that this person wants to maintain a constant level of consumption and expenditure, shown here by this red line, at about £15,000 a year, which is the total lifetime income earned by that person divided by the number of years that they live. They would have to accumulate wealth during the years when they're working and then decumulate this while they're in retirement. So here, people will be saving this amount between their income and consumption, and then in the early or during the years that they're in work, and then in the later years, they're decumulating, so dissaving or just withdrawing those assets and savings that they've accumulated by that point. So this is essentially the consumption smoothing rationale for retirement saving. So retirement saving is a way for people to move resources from the years in which they work to the periods when they're retired. A particular part of pension saving that makes it so challenging is that even with if we're looking at people who have no cognitive limitations, they have kind of perfect financial literacy. They understand pensions completely. They don't face any market distortions or behavioral biases. Even for those people, what's true about their their lifetime is that they don't know when they will die. And this is something that in the context of pension saving, we call longevity risk. So people face a risk of living less or more time than what they had expected to. So for example, in this example that I showed you, if the person got to 100 years old and then realized that they had another 10 years of life left, they would have already accumulated all their wealth by that point, and they wouldn't be able to maintain the level of consumption that they previously had. So how could we solve for this? So the way that people kind of traditionally can protect themselves from longevity risk is by having what's called an annuity, and people can buy a financial product called an annuity. So this is essentially a product that guarantees to pay a fixed income to you until death. And like with any insurance product, here the insurance provider takes on the kind of longevity risk, and you essentially have to pay an insurance premium for this, which in this case means that the payouts that you can expect to receive will be smaller than the amount that you spend to buy this product in the first place. Just to give you a sense of this, for example, if you were 60 and wanted to buy an annuity this week with a £50,000 pension pot, you could buy an annuity that would pay you just under £2,000 a year until death. Now, that might not sound like a lot, especially if you expect that you might only live, say, 10 years after 60. But actually, life expectancy for women, for example, women who turn 60 now is about 30 years. So they can expect to live up to age 90. So the insurance company in that case would have to pay such a woman about £60,000 over those 30 years. So with this kind of product, people can maintain that stable level of consumption until the end of their life. So if people value stable consumption, they can insure away the risk of running out of income by purchasing an annuity. So essentially, this is why pension saving is important. It's a way for to move resources from working life to retirement. And in case of an annuity or an annuitized saving product, can also guarantee an income in retirement, protecting against longevity risk. Now, if we think of the standard life cycle model, in this model, people face this trade-off between saving and consumption. And if they are, as the standard model assumes, fully informed, they can calculate their returns on savings, there are no market distortions, and so on. People, according to the model, will make the right choices for themselves when they're deciding how much to save for retirement and how much to consume today. And if they're worried about longevity risk, they could annuitize their savings. However, in reality, what we see is that is quite a lot of government intervention when it comes to pension saving. So I'll now kind of explain why that is. So why can't the government trust people with these decisions about their pension saving? Well, there are many reasons why people may not behave as the traditional model predicts. So we have both behavioral biases, which mean that governments think that they need to interfere, and also some things that might lead to market failure. So firstly, many of you might have heard of these behavioral biases also in the context of pension savings. So some of these include present bias. So this means that people save too little because they value consumption more today, and they over discount consumption in the future. So people might, for example, think that they prefer consumption today, they will start saving tomorrow, but then when tomorrow comes around, they will again prefer consumption in that current period and will not save. Another very thing that we talk about a lot in the pensions space and this pensions policy is inertia. So this is basically relates the fact that people stick to a default option when it comes to their pension savings, and in general, there's more cognitively difficult decisions. So there's this kind of lack of engagement with pension saving decisions, and people tend to not react to changes in their circumstances and so on. So that's what we mean by inertia. Another bias that we see in in people's thinking is the bias in assessing probabilities of future events. So people often inaccurately assess the risks and uncertainty that that are related to many of the components of pension savings, and they can be overly optimistic or pessimistic about these really important aspects. So there are a lot of things that are then can be uncertain, like what are their lifetime earnings growth going to be, or what are the kind of level returns that people might expect to see on their retirement. And we also know from some earlier IFS research that when people are asked about how likely they think that they are to survive to a certain age, they're generally too pessimistic about surviving past age 75 or 80 or 85. And of course, this is hugely important in the context of pension savings, because it means that that people might think that they're going to live or die earlier than they actually will, and that means that they might not save enough or might run out of money. So these are the kind of behavioral biases that we see, which mean that governments will want to intervene and correct for. In addition to this, there are other reasons. So the pension saving is kind of inherently a very difficult thing to do. Understanding all the different aspects of risk and return, being able to calculate expected returns accurately, making decisions between different products and so on, all of this is hugely difficult. So a lot of people don't necessarily have the required level of financial literacy or knowledge of pensions. So these are all the kind of sort of different biases that push people away from the decision to save for a pension. So a government might want to intervene if they think that the right decision for people would be to save. But the government could also decide to intervene because of market failure in the pension market. So in particular, in the annuities market that I talked about, so this is the insurance product that gives people an income stream for until death. There's a lot of asymmetric information in insurance markets, which can lead to adverse selection and potential market failure. So essentially, again, annuities and insurance against longevity risk. So of course, this kind of guaranteed income until the end of life is more valuable for someone in very good health who is more likely to live longer, or it's not necessarily worth purchasing for someone who knows or thinks that they only have a few years of life left. So we might end up in a situation in the annuities market where the insurance companies offer annuities based on assumptions around kind of the average health and longevity of the population, but only those with very good health buy these annuities. So then the insurance companies end up losing money on annuities because they end up paying out for longer than they'd expected. And this can lead to a situation where the whole market collapses, or at least becomes very unattractive for most people. So this is what we call adverse selection. And this is the reason why these kind of pension products or longevity insurance, as well as other types of insurance like health insurance and social care insurance, more generally, are so difficult for private markets to provide. There's also another reason why governments might want to intervene in pensions, and that's for redistributional purposes. So pensions can redistribute income between different people, and pensions can do this in a way that where redistribution is done based on lifetime earnings rather than a single year of earnings. And this, is of course important, but this is not what we're going to be focusing on today. So this is why the government needs to intervene in pension saving. So the governments generally understand that pension saving is important because it helps people smooth their consumption over their lifetime. And they see that because of these biases and distortions, people wouldn't be doing it if it wasn't for the government intervention. So how is it then that governments intervene? So I'm now going to be talking about first just public pension systems more generally, before moving on to the UK context specifically. So many countries have these public pension systems where essentially the way that governments push people into saving for their retirement is by having them pay taxes and mandatory contributions into pensions during their lifetime, and then they will receive a pension benefit from the state in retirement. We can also call this sort of social insurance. The government has this structure to insure people from poverty in retirement as well as longevity risk. When we're looking at these public pension systems in general, I think it's really important to first make the point of the kind of context in which most developed countries find themselves when it comes to demographic change. So as you know, populations are aging, so people are living longer than ever. This graph shows that for the UK, when we're looking at in the 1980s, men and women who turned 60 in 1980, how many years were they expected to live at that point? So in 1980, women were expected to live until 83 and men to 79. Now, what this graph shows is that number, that life expectancy has increased for both men and women over since the 1980s, but quite dramatically. So women can now expect to live 7 years longer and men a whole 9 years longer. And also what we see here is that if we look at these projections for 2060, this trend is expected to continue. So on this slide, I'm going to be talking about how this affects a public pension system, this system where people pay taxes and mandatory contributions during their lifetime and receive a pension benefit from the states in retirement. In particular, what's important to understand here is I'm going to be talking about specifically a pay-as-you-go public pension system. So that's what this PAYG refers to here. So this means that under this kind of system, which we have in the UK, for example, this means that the current pensioners' pension benefits are paid out of current taxation. So it's not paid from the pension contributions that they paid for themselves. So, for example, my tax payments today are funding the pensions of retirees today, and then when I'm in retirement, that will be funded by the taxpayers at that point. So I'm going to be listing kind of different demographic trends and show their impact on these the taxes and benefits, as well as the pay-as-you-go pension system in particular. So, as I already mentioned, people now tend to live longer. And what this means is that the total pension payments for governments are higher because there are all these additional years in which people will have to, or the government will have to pay the pension benefits. So that means that there's more money going out over time. The other side of this is that, of course, if people just stayed in work the same number of years longer than as their life expectancy has increased, we wouldn't necessarily have this issue of governments having to pay these pension payments for more years. But what we see is that actually people spend more time in retirement. In the last in the last decade or so, we have seen an increase in the employment rates among older workers. But for example, if we're looking at older workers or men aged 60 to 64 today, their employment rate is about 60%. So about 6 in 10 men in that age group are in work, whereas in the 1970s, it was closer to 80%. So essentially, people are not retiring kind of sufficiently later to make up for the increase in life expectancy, so they spend more time in retirement. People also enter the labor force later. So this is mostly because of university degrees becoming so much more popular. But together, this means that people spend a smaller proportion of their life paying taxes. The other thing that we see in most developed countries is that fertility rates are falling. So that means that also in the future, there are less taxpayers in total. So both of these things then together means that there's less money going into the pay-as-you-go pension system. So essentially, we have this imbalance where we have less money going in, more money going out, and this is a challenge to the sustainability of public pension systems. So what can a government do to adjust for this? Well, they could try and fix this by balancing the size of these two arrows. So firstly, a government could increase people's mandatory contributions or taxes to help pay for the bigger pension payments. So this is what governments in many European countries have done in particular. So those countries treat pension as a social insurance. Like I mentioned, social insurance is a way in which the state collects contributions and tax and then protects us against risks such as sickness, unemployment, or longevity or poverty in old age. So in the context of pensions, this means that people pay these pension contributions during their working life and then earn usually an earnings-related pension from the state in retirement. So when the contributions are increased in this social insurance system, you make it more sustainable because there's more money going in. It also means that there's more redistribution, both for the kind of less well-off pensioners and also from the younger generations to older generations. But this choice does come with potential trade-offs. So increasing taxes can lead to labor supply distortions. And what I mean by that is that it can decrease the incentive to work. So when people have to pay more tax, they are receiving a lower wage for the given amount of work that they've done, and they might respond by working less. And this can increase debt weight loss, and this is what we often call the equity efficiency trade-off. Another issue is moral hazard. So if people know that they have a generous, say, pension or a public pension, they're less likely to save privately. And this is another trade-off that governments face when they're increasing these taxes and promising a more generous state pension. So what else could the government do? Well, it could actually reduce the generosity of the public pensions, so reduce the amount that is paid out. This should also incentivize private saving, so essentially pushing the responsibility of the pension saving to the individual. Okay, so at this stage, I'm going to explain the UK pension system, so we can look at the ways in which the pension system works specifically in the UK, and also we can look at the ways in which it has changed in response to the changing demographics of the population, and then how the UK government has responded with more policy to encourage more private saving or employer pensions, which is a very important part of the pension picture in the UK. So the UK pension system is made up of a few different components. And I think kind of a quick summary of what this system is that it's state provided pension, which is what I call state pension, complemented with some private saving. So we have the state pension. So this is, or what can also be called public pension. So this is the government pays this flat rate to anyone with over 35 qualifying years. So years in which people have been either in work or taking care of young children mostly. And since 2016, this has been a flat rate pension. So everyone with the full number of qualifying years get the same amount, and there's no earnings related part. Previously, this was actually earnings related, so it functioned more like a social insurance, but this is now a flat rate pension where the flat rate is calculated sort of as a rate that protects older people from absolute poverty. And the system is pay as you go, as I mentioned before. And anyone over the state pension age, which today is 66, can receive this state pension. But the state pension is just over £9,300 per year, which is about a third of median earnings in the UK. So while it protects people from kind of absolute poverty, it's not enough for most people. So traditionally, employers will also offer some sort of employer pension for employees. So because this is not arranged by the states, these are a type of private pension saving, but we call it employer pension here because employers usually arrange them. And they will also make some contributions into them on behalf of their employees. And there are two types of employer schemes. So the first one is defined benefit. So in a defined benefit scheme, as the name suggests, it sets out a formula for calculating the amount of money that an employee will receive in retirement. So it could be, for example, that for each year of service, you get 1/60th of your final salary as a pension. So if you work for the same company for 40 years, you'd be guaranteed a pension that's 2/3 of your final salary. So as this example illustrates, most of the risk with this kind of pension lies with the employer. So even if your pension contributions and the returns to those contributions don't actually cover 2/3 of your final salary until the end of your life, this is what you've been promised. So this is what the employer will have to pay you. So that's the issue with this scheme from the employee's perspective. On the other hand, is that they're not usually very portable. So if you leave your job, you would then stop accruing additional years, and you might lose out. But essentially, what both the defined benefit scheme and also the state pension give you is an annuitized income stream, in the sense that you get an income until the end of life, which is guaranteed. Now, another form of pension saving is defined contribution pensions. So as the name suggests, here the employee and employer agree a rate at which they contribute to a pension pot. So the individual can usually choose how much of their salary they want to put in, and they can also make some choices in terms of which kind of financial products or what kind of risk level their fund is invested in. Then, as the person reaches retirement, their pension income will be determined by how much of their own pot, pension pot, so the amount of money that they've saved into a pension, how much they've paid in, and how much that has accumulated returns. And essentially, after the age of 55, people can decide how to draw that wealth down. So in this case of the defined contribution pensions, the market risk, so how the stock market performs, for example, and how the other assets prices perform, and also the longevity risk, so the risk of not knowing what age you live until. Both of these type of risks with this kind of pension lie with the employee rather than the employer or the state. Finally, people might save for a pension in other ways, such as having a house, owning a business, having stocks and shares, or arranging their own pension fund. But the key difference with most of those kinds of savings is that there's no kind of commitment device. So people could withdraw those savings at any point, whereas with a pension, there's usually some sort of an age until that you have to wait until before you can start receiving your pension. So we're not going to be focusing on those other forms of savings today. So this is the pension system in the UK in a nutshell. And I'm now going to talk about the changes to this UK pension system in recent decades. And I'll start by talking about what's changed in the state pension system, then talk about employer pensions, and then talk about some of the policy responses to these changes. Now, as I already mentioned, some countries have responded to the kind of demographic challenges to their public pension system by increasing the amount of contributions that people are required to make, and that way ensuring the sustainability of the system and making the system more contributory and providing more social insurance. Now, the UK has taken a slightly different approach when it comes to improving the sustainability of the pension system by reducing the generosity of the state pension. So how have they done that? Well, firstly, the government phased out or is phasing out the earnings-related part of the pension. So we now have this flat rate across everyone. So as I've mentioned, this means that the state pension is now more about protecting older people from poverty, rather than having being this kind of a pure social insurance where higher contributions would lead to higher benefits. And on average, it means that state pension is less generous for people. In addition to that, another important way in which the government has reduced the state pension generosity is by increasing the state pension age. So this is the age at which people can start receiving their state pension. And I'll just show an example of this, showing how women's state pension age in particular has changed over time. So here on the horizontal axis, we see the year of birth of women, and on the vertical axis, we see the age at which they can start receiving state pension income. So since the 1940s, the state pension age was 60 for women. It was 65 for men. So in 1995, this Pensions Act was put in place that basically said that the state pension age of women would start increasing in 2010, and it would be equal to men's by 2020. There have been further changes since then, kind of bringing forward the increases and also adding more increases for people born later. But what this picture shows is just how dramatic the change was and just what a big difference it made to the generosity of state pension. So if we compare a woman who was born in 1949, who started receiving the state pension in 2009 when they turned 60, if we now compare them to someone born in 1961, so they would have also turned 60 this year, but actually they would only start receiving the state pension income at the age of 67. So essentially they are getting paid the state pension income, which is over £9,000 a year, for 7 years less than the women who were born just 12 years earlier. So this kind of shows just how this change in state pension age affects people and helps make the system more sustainable. These increases to 66 and 67 also apply to men. And for someone, for example, in my generation, the current legislated state pension age is 68, but it's also likely that it's going to continue to increase as life expectancy increases. So that's basically the state pension side of the picture. So we've seen a reduction in generosity there. Just as as kind of a side note here, in other countries, the conversation often revolves around what happens in terms of the state pension. But in the UK context, it's also really important to think about the employer pension, as I mentioned. So, and that's played a really important part in the UK's pension saving picture for a very long time. So in the UK pension system, the state pension has been this less significant source of income than in a lot of other countries. So here we see the net replacement rates for average earners across the OECD. So what these bars basically show is what percentage of the net income an average earner will earn from state pension compared to the average earnings. So as I mentioned, this is about 30% in the UK, whereas in some countries it's sort of close to 100%, and even the average is well above 50%. So this is why in the UK, when we're talking about pensions, it's really important to also talk about the employer side of the picture, because the state pension only makes up one part of pensions. But the state pension is not the only part of the system that's become less generous. So I talked about the definition between defined benefit and defined contribution schemes. And as you might know, a lot of the defined benefit schemes have actually come to an end and have been are being phased out for very similar reasons that the state pension has become less generous. They're not sustainable because, especially as people's life expectancies keep on increasing, so companies have been tied to paying out these pensions for much longer than what they had expected. So partially as a result of this, a much more prevalent form of employer pensions is now defined contribution pensions. So the employers still have to pay pension contributions on behalf of their workers, but the difference is that they're not liable for any future payments as they would have been under the defined benefit schemes. So essentially what we've seen in the UK is this transfer of risk. So where previously the market risk and the longevity risk of pensions lied sort of almost solely on the state and the employer, the risk has now been transferred to the individual, and it's their responsibility to ensure adequate income in retirement. But as I discussed in the first section, there are many biases, which mean that people don't save optimally, and individuals aren't actually necessarily best placed to make these really complex decisions about retirement saving. So because the government has now transferred the risk to individuals, they again have to then intervene to try and overcome the biases in pension saving and encouraging people to save more privately. So how did the UK government do this? So I will now talk about a couple of the policy responses to the transfer of risk. So the first very well-known policy response is known as automatic enrollment. So this was introduced in 2012. So since then, every employee aged 22 to 64, earning above £10,000 a year, must be automatically enrolled to a pension scheme. So this policy tackles both inertia, because it doesn't require engagement from people, and it also tackles present bias by nudging people into saving today. And this policy has been hugely successful in encouraging people to save for a pension, especially when considering that really the only thing that's changed here is the default option. So what I'm going to show here, so this chart shows the impact of automatic enrollment on employees. But first, I'm going to show what percentage of working age individuals who are self-employed are saving into a private pension. So what we see here is that in the late 1990s, about half of self-employed people were saving into a pension. And this has been declining over time, all the way to where we are today, which is below 20%. And what you need to know here is that self-employed people are not subject to automatic enrollment because they don't have an employer, essentially. So what does the picture look like for these employees instead? So we can see that in the late 90s, the rates of pension saving were pretty similar for self-employed people and employees. And what we saw from the late 90s to 2012 was this decline also among employees, not quite as steep as among self-employed, but still a decline in pension saving of the self-employed people. But since 2012, we really see this huge impact of automatic enrollment on pension savings of employees. So very quickly, the rates of pension savings started increasing, and that's also the rates has continued to increase since this data set as well. So this policy essentially pushes people into saving into a private pension. But there's also another side to this, another policy response that the government came up with. So in order to make sure that pensions are an appealing way of saving for most people, so that they have less of a reason to opt out, the government also responded by introducing what we call pension freedoms. So previously, most people who had a pension pot and had saved privately into a pension had to buy an annuity with their pension pot. So even though this was money that people had kind of saved themselves, the rules of how people could access this money were very restrictive. Since 2015, however, people can now still withdraw 25% of their pension pot tax-free, and they can also draw down the rest of it flexibly after the age of 55. So people can decide what they want to do with the money that they have saved into their pension. So just to summarize this section, the UK has moved from kind of providing this public pension as a form of social insurance to reducing the generosity of the state pension, which makes the system more sustainable, but leads to a need for individuals to save privately. So ensuring sufficient income in retirement is increasingly the responsibility of individuals rather than the state or the employers. So in order to encourage people to save privately, what the government has done is try to nudge people into saving by introducing automatic enrollment, which then overcomes things, biases such as inertia and present bias. And also then they've introduced pension freedoms, which give people more freedom when it comes to choosing how to draw down their pension wealth. This is maybe was a surprise to many people, given that many of the same biases and distortions that we see when it comes to the accumulation phase, so the saving phase, also apply at the saving phase. So people still might be biased by things like present bias and so on. But this does make pension saving perhaps a more appealing way of saving for many people. So I will now just conclude. So pension saving is important because it helps people smooth consumption throughout their lifetime. But as with most saving, people might not behave optimally because of these many behavioral biases and also other distortions, which are also things like longevity risk, not knowing or being overly optimistic or pessimistic about life expectancy and so on. All of these things are particularly challenging for pension saving. So this means that in most countries, or in most developed countries, that these governments have decided to intervene when it comes to pension saving. And in the UK, the changes in the UK pension system means that there's been this risk transfers from employer and state to individuals. So, and then, but that means that then the government has had to respond by nudging people into private saving, and then giving them more freedom in terms of how they want to withdraw their savings. And I think, just a thought to finish on, I think, especially in the UK context, where there's so much of the responsibility of pension saving lies with the individual, it's really increasingly important for people to have an understanding of pensions and the pension system. So I hope this talk has kind of helped you get started on that path. Thanks very much. And I think we're now ready for some Q&A.
Thank you, Haley. That was great. So we do have several questions on Slido. So the most popular one seems to be, what did COVID-19 do to impact on, how did COVID-19 impact pension saving in the UK?
Right. So COVID-19 is obviously a very, did a lot to the, in terms of things like the effect that it had on people's incomes, the effects that it had on people's or stock markets and so on. So there are a lot of things that we kind of would think or might think that would have affected pension saving. So, but actually what we see from the data, or the early data at least, is that actually the pension participation rates remained very similar to what they have been before. People didn't seem to be opting out of pensions either. They didn't seem to be reducing their contributions and so on. So this is actually quite surprising or you might think that it's quite surprising, especially as something like a quarter of the UK workforce was furloughed, so was facing at least a 20% cut in their incomes. So basically, I guess what we could take away from that is that even in the context of COVID-19, we still saw this kind of really strong evidence for inertia. Of course, it might be that people didn't need to save or stop saving because they were consuming less, for example. Mm-hmm. But actually, what we also see in the data is that a lot of people were saving more. But again, we don't really see evidence of people increasing their pension contributions. So whereas that might have been kind of very beneficial for the people who ended up saving more. So again, there seems to be this evidence of inertia, both in terms of not responding to negative shocks to incomes or negative events, but also we didn't really seem to have any movement in the other direction either. So it looks like there wasn't a lot of engagement with pension saving, despite this kind of very very salient and very large events that was happening.
But obviously, it affected the value of the stock market quite a lot. So there was a big drop, and then subsequently it's gone up. So do we think that's likely to affect people's behavior going forward?
Yeah, so that's a really interesting point. I think so. Because people now have this freedom to decide what they want to do with their pension savings. I think there was this fear that people might, get scared by what's happening in the stock market and might withdraw a lot of their funds. But actually, we didn't see that happening. So actually, there were less withdrawals from these private or defined contribution pensions during COVID. Again, might be because people were consuming less and so on. But we don't really see evidence of that. I think also many of the way that many of these pension funds are structured is that if you're close to retirement, so you're kind of getting close to thinking about withdrawing, the pension funds, the risk profile will usually be a little bit different, where actually more of your pot will be invested in things like bonds that don't respond in the same way to market fluctuations. So, for example, stock markets fell by 20-30% in March 2020, whereas we didn't really see a similar effect in a lot of these bond markets. So essentially, for the people who were already kind of thinking about withdrawing, their assets were probably already invested in a way that means that they weren't as affected. And obviously, for younger people whose pensions are invested in the stock market, that they did recover very quickly. So hopefully, it kind of does give people some comfort in that, even if you see temporary dips in the stock market, overall, that's a good place to put your pension money, because then over time they are most likely to recover.
That's interesting. So you talked a little bit about pensions freedoms there. There was one question relating this a little bit back to the theory that you were talking about earlier, which was, so when these pension freedoms were introduced, did people stop buying annuities? Did things change in the market? You talked about adverse selection before, but is that something that we actually saw in practice?
Yes, it is. So basically, as I said, the rules used to be that for a certain size of pension pot, you had to buy an annuity. So the market was there. Once the pension freedoms were introduced, actually these days we see a very small minority of people buying annuities. So the market is still there. It didn't completely collapse, but it's quite unattractive for most people in terms of the products that can be offered. So we did see kind of adverse selection happening in practice there, and a lot less people nowadays have. A lot fewer people nowadays have these annuities.
Do we think it's likely that they would reverse that? Would we think that a future government might think about reintroducing compulsory annuitization?
Well, I mean, I think it's I'm not sure I have a immediate view on at least how quickly that would happen. I think pension freedoms for a lot of people is quite a popular thing. The fact that you can withdraw this money that you have saved yourself, if you need to say, what we find again in research is that a lot of people might use it to help their children get on the property ladder, or use it for a big holiday or so on, which isn't necessarily what we want them to do with their pension money, but it means that it's a very kind of popular thing. So it would be kind of politically probably quite difficult to go back to that, especially now that people are so used to the fact that their pension money they can kind of use as they wish. So it would be difficult, and especially when it comes to pensions. so if we make decisions on or changes into how people can access their pension funds, for example, if that applies to everyone, then that would mean that some of those people saved that money kind of decades before, and so it's quite difficult to make these changes because it kind of has an impact, a very long-lasting impact, and can change how people might have viewed their pensions when they were saving earlier on in life. So
okay. So another question is again about annuities, but someone asked, why can't the insurers invest the money that pensioners pay in when buying annuities? And maybe they do. So do they take the money that people use to buy the annuity in the first place and then invest that themselves? The example here is if they got a 4% return from those investments, then they could just provide those 4% annuities forever.
So people, the pension funds can do that, and I think they do that as well, where they will want to invest in assets where the payments that can kind of help create this profile, that they kind of stable profile of payments in the future. But I think the kind of issues of adverse selection and so on still remain, in that for some people the price, the kind of insurance premium will be difficult to set in a way that means that it's kind of a attractive product for certain people to buy, and then that leads to those same kind of issues.
Indeed. So another question asks, are the increases in the state pension age unique to the UK, or are they happening in other countries too? Is this a global problem, or is this just something that the UK is dealing with?
No, I think it is definitely happening in other countries, as well, because obviously most countries are facing this same issue. So and most countries are also facing this kind of combination of issues that I mentioned. So people working for longer, since the kind of 70s, having reduced or retiring earlier, joining the workforce later, and also fertility rates falling. So most countries are facing those same issues, and most countries have recognized that even with increases in the mandatory contributions, it's not enough to kind of make up for those. So then the other thing that they've had to do is also increase state pension age. Of course, we also then have examples from countries like France, where there's a push for that to happen, but actually, again, politically, it's been a lot more difficult than it has perhaps been in the UK. So that's kind of somewhat a difference. Although interestingly, for example, the increase in the women's state pension age of 5 years was introduced in 1995 and only implemented from 2010 onwards. So the issue there was that a lot of people didn't actually know about it and didn't know that it was happening. So maybe that was made it politically a little bit easier to implement. But yeah, that's.
Well, of course, some people have still been very upset by it.
Exactly. Yeah.
So I mean, I guess. Thinking about all those pressures, there's a couple of questions here that are quite related, which is what do we think the future of pensions looks like? So someone asked, given all of these trends, do you think that there will be a public pension system in future, or by the time you retire? And someone else has also asked, you refer to the UK state pension as a pay-as-you-go, but it's actually a state benefit. What are the chances the government may decide to save funds by making it means tested? So do you think that means testing or just getting rid of the public pension system entirely are possible reforms to the future?
Well, I think that getting rid of it completely is sort of unlikely to happen. I think what the government wants to do is protect people from kind of, as I said, absolute poverty, or being living in poverty in retirement, and also, especially when you have these kind of the private saving is very flexible. government wants that there is this kind of minimum amount or a relatively small amount that people will receive no matter what happens to kind of their in their private pension savings. So I think that is likely to remain in place. That's my view at least. Of course, the means testing is something that could happen, especially in the UK. So the state pension is only tied to your state pension age. So there are people who might be working in still past their state pension age who are receiving the state pension. So maybe something like that could change, or people who have very large private pension pots would not receive that. But I think at the moment we don't want to create kind of a disincentive for private saving by saying, oh, if you have more private saving, you're not going to receive the public pension, or if you continue working, you're not going to receive the public pension. So yeah, it's I don't think it's going to happen anytime soon, but of course we'll see. We'll have to see how these things develop in the future.
Yeah, and as you say, most of the policy seems to be kind of pushing towards increasing incentives for private saving. So you talked about automatic enrolment, and there were a couple of questions there as well. I mean, given it seems to be very successful, do you think it should be applied to everyone rather than just to employees, certain places?
Yeah, so there are a couple of the automatic enrollment has been very successful, but there are some issues with it. It is a completely sort of blanket policy, right? So what some IFS research has found, for example, is that there are some very financially vulnerable people who, for example, say that they can't keep up with their bills, they don't have any kind of liquid savings, and so on. And before automatic enrollment, a very small proportion of those people were saving into a private pension, probably because it made sense for them to be spending it on things like bills today. After automatic enrollment, you don't really see a difference in the rates of private pension saving between that group and the groups that aren't financially vulnerable. So there is already a kind of argument that should we really be pushing those people into pension saving who are struggling today, and for whom if their incomes are quite low, the kind of income that the state pension provides relative to their incomes in their life earlier in their life is actually kind of more palatable. So I think that's kind of one of those things why, for example, currently automatic enrollment only applies to people who are earning more than £10,000 a year. And there's a bit of a question mark of whether that should be lowered, and probably makes sense that it's not, at least immediately.
And there's not an argument for changing the amount that people should put in. Maybe you could differentiate that by how much people earn in the first place.
Yeah, so that's definitely something that could be done. The thing with that is also that earnings is kind of only one part of your financial situation in a way. So it probably should take into account other things like whether you have a mortgage, or whether you have still paying your student loan, or whether you have children, whether your children live with you, all those things. Of course, we could try and incorporate all of those things into defining the default rate, but
sounds complicated.
It gets pretty complicated pretty quickly. So, but again, yeah, we've done some research on those kind of looking at how should people save, and find that all of these things play into how much people should be saving. So yeah, it's a bit more complicated in that sense.
And just finally, I mean, we touched, this has all been for employees. What about the self-employed? It seemed to be quite a worrying trend that was falling quite so fast.
Yeah, so the self-employed is definitely something that the government is quite a group that the government are quite worried about. The difficulty there, of course, is that they don't have this kind of stable, or they don't have an employer who will enroll them into this, and also so they don't have a paycheck where you kind of deduct the pension payments from. So it kind of just technically it's difficult, but also a lot of the for a lot of the self-employed people, for example, they face large fluctuations in their incomes. Again, they were a group that were very severely affected in the early stages of COVID-19. So for that group, it might actually make, for a lot of them, it makes more sense to keep their savings in a more liquid form that they can access if they have issues with their business, for example. So yeah, there are also arguments for trying to increase some sort of saving among that group, but the government's kind of running some pretty interesting trials into trying to find what it is that the kind of product that actually would benefit those people the most.
Great. Well, we'll have to look forward to future research into that to learn the answers. Anyway, thank you very much, Hayley. That was really interesting. For those of you who've enjoyed it, next week we'll be back to talk about income inequality, how it's changed over time, and why we might care about it. So until then, have a good week.